Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger Associates Financial Planning. Pleased to have Nick DeVito, also a certified financial planner, as well as a owner of the firm. So thank you for joining me, Nick.
Thanks for having me.
We're going to talk about today sort of timing, smack dab in the middle of us doing all our year-end tax planning. I'm like, well, gee, you know what? Tax loss harvesting. Might not, people talk about it, but I'll tell you, we have a lot of different spins on the whole thing. And so what we want to do is we want to share with you the concept of tax loss harvesting, why people do it, how it works, and some of the fundamentals behind it. And if this applies to you, then take it and use it as you feel fit.
Well, and one thing I know we're going to talk about, people are very familiar with, or at least have heard of, tax loss harvesting. But I don't think many people have heard of tax gain harvesting, because there are unique opportunities there where you may be able to take gains and pay little or no tax on it.
Right.
And that's something people don't talk about as much, but something we'll certainly talk about today.
Well, yeah. I mean, at the end of the day, what we're trying to do is maximize tax efficiency. And to your point, I've taken gains. People look at me cross-eyed sometimes as to why I'm taking gains, but it's always about what's my tax bracket now or what might it be later? And there's just a lot of different strategies that go with it. So what is tax loss harvesting? So people think of tax loss harvesting, or at least in our profession, people say, oh, well, tax loss harvesting, I have $20,000 in gains. Let me find a way to offset those gains. Makes sense, right? Because you got to pay taxes on the gains. But it doesn't always make sense.
Yeah.
Okay. And so let's talk about it. So what happens when someone takes a capital gain? It's very simple. It shows up on their tax return. Okay. Well, how much tax do they pay?
It depends.
There you go. Good answer. The answer to almost every question. All right. So tax loss harvesting, or shall I say, let's step back with the gains. Okay. We need to differentiate between short-term capital gains and long-term capital gains.
Well, even further back, I think we need to explain what exactly a capital gain is.
Yeah.
So a capital gain, if you buy something, let's say for $10,000 and sell it for $15,000, the capital gain is the $5,000 in growth, not the whole amount. I know that's something people get a little confused with. What we're going to be talking about today with capital gains, this only applies to non-qualified investment accounts. And what I mean by non-qualified is non-retirement accounts. So this is just your regular investment accounts where capital gains apply. Sure, you can technically have capital gains in an IRA, Roth IRA, but it doesn't matter. Those gains don't matter. What we're talking about is the regular investment accounts. So once again, you buy something for a certain price, that's your cost basis. So the $10,000, that's your cost basis. You're never going to pay taxes on that again. You already paid taxes on that. The only thing you're going to be paying taxes on is the capital gain, which is that in the example I used earlier, the $5,000 in growth.
Right. And then there's a difference between a short-term capital gain and a long-term capital gain for the Fed. Pennsylvania and most other states don't care if it's a short or a long-term capital gain. They just charge you a tax on the gain. I don't know about how other states work, but Pennsylvania does not allow you to take a loss. Okay, take that into consideration because that's important to know. So a short-term capital gain is taxed as if ordinary income. What is a short-term capital gain? Well, anything that's not long.
There you go.
And a long-term capital gain means if you held the investment for more than 1 year or a year and a day. So that's considered a long-term capital gain, which gets preferential tax treatment. So what happens here is your first two tax brackets for married are at 10% and 12% up to about 100,000. It's like 96 and change. Those tax brackets for a long-term capital, or shall I say, for short-term gains or ordinary income are 10% and 12%. But for a long-term capital gain, it's my favorite tax rate.
0.
Okay, 0%. That's correct. The next set of brackets are once you exceed 100,000, get $96,000 and change, all the way up to almost 400,000. And those gains are taxed at 15%. But the ordinary income tax rates, which are the same as short-term capital gains, are 22 and 24. Actually, it goes even higher on the 15%. It goes all the way up to like 500 and it's almost 600,000.
Yeah.
Like 600,000, which means you're going through the 22, the 24, the 32, and into the 35% tax bracket if it's a short-term gain. But if it's long-term, it's 15%. So there again, 15 beats 22, 24, 32, and certainly 35%.
Yeah, and it's important to distinguish how the two of those operate. Another thing to consider, and one thing I explain to clients is if you're getting close to that year and a day, it may be worthwhile to wait to sell. Let's say you want to sell an investment and you're at 364 days, and I'm exaggerating a little bit there. Wait the 2 extra days if you're going to be selling it at a gain because you'll get better tax treatment on that gain. Now, don't let the tax tail wag the dog, meaning if you have an investment that's up and you want to get rid of it and you really don't think the outlook isn't positive, don't hold on to it for 3 months just to get that preferential tax treatment, because if there's no gain, it doesn't matter anyways. And I have seen people do that before where they wait. They're like, no, I want to get the long-term gain. I want to get the long-term gain. And then the gain erodes and now they have a loss.
Right.
Like, okay. Well,
even if it's not a loss, I mean, the fact of the matter is they might have had a $20,000 gain and it leaked its way all the way down to a $2,000 gain. They just lost 18 grand.
Yeah.
Which is more than the difference of what the capital gains in many cases. So to your point, don't let the tax tail wag the dog. But the next point, it's clearly advantageous to have a long-term capital gain versus a short-term capital gain. And then there's losses. Okay, well, the way losses work is very simple. If you buy an investment for $15,000 and sell it for $10,000, you get a $5,000 loss. But to be clear, the Fed only allows you to take up to $3,000 in losses on your tax return in a given year. So
losses that offset ordinary income.
That's correct. Thank you very much.
There's kind of a pecking order, if you will, if you have losses. And you can have a mix of long-term gains, short-term gains, long-term losses, short-term losses. But your long-term losses are going to first offset your long-term gains. Your short-term losses are going to offset your short-term gains. And so there's a pecking order. And then if net you still have losses after all your gains are offset, then you can use it to offset your ordinary income up to $3,000 a year. Now, if you have more than that, let's say you have $10,000 in losses and no gains, for example, you can offset your $3,000 of ordinary income, and that remaining $7,000 gets carried forward, and it's a loss carry forward that it can be used to offset either future gains or ordinary income in future years.
Right. So the problem that I have, one of the things to take into consideration is, certainly for Pennsylvania and many other states, is they don't allow you to take a loss. So if I'm doing capital loss harvesting or tax loss harvesting at the end of the year, if I'm going to do that and I have $10,000 of gains already booked, I will actually target $13,000 in losses. Now, what will happen there is I get $3,000 in losses going against the ordinary income tax brackets on the federal side. The reason why I don't exceed it is because I can't take the deduction against Pennsylvania, okay? Which means if I took a $10,000 loss, I can't write anything off against Pennsylvania. I can only write 3 against the Fed. I have a $7,000 carryover. I have $5,000 in gains. It wipes out my Fed, but I have to pay the taxes in Pennsylvania. So it really doesn't work very well from the state side to be taken too much in the form of losses. So what do people do? They'll look at it and say, gee, I got $20,000 in gains. Let me look for ways that I can take losses. Great. So if they find $15,000 in losses, that 15 will go against the 20. And now they're only reporting $5,000 in gains. Mm-hmm. Simple enough. All right. On the surface, it always looks like that makes the most sense in the world.
But that's not always the case.
That's correct. So because of the fact that a loss goes against ordinary income, sometimes you say, I want to take it up to $3,000 above, or If I have short-term losses, they'll go against short-term gains. And what I've done before is I know long-term gains are taxed at 15%, or in this case, right? In a particular case, in most cases. What I'll do is I will intentionally hold short-term losses for the following year. Because what that does is it gives me a little ace in the hole, so to speak, that it gives me the ability to offset short-term capital gains if I take them next year.
Yeah. Well, and to your point on that, sometimes it's not always beneficial to be offsetting the long-term gains.
Right.
Because to your point, they're going to get taxed at a preferential rate of either 0, 15, or 20%. And if you're offsetting gains, long-term capital gains, and you're in the 0% capital gains bracket, you're not really benefiting yourself.
You're not.
At all. And that's where it may make sense to wait till the subsequent year. If maybe your taxable income is going to be higher the next year, you can use it to offset ordinary income the following year, which I think we'll touch a little bit more on. But that's why it's not always advantageous to be taking those capital losses. You don't want to be taking capital losses just to take capital losses.
Right.
You kind of want to have a plan in place and a rationale behind why you're doing it, and a target, if you will. To your point, okay, maybe you had $3,000 in short-term gains and you have $4,000 in short-term losses, and you have some long-term gains on top of that too. Well, maybe you only take that $3,000 in short-term loss and offset your short-term losses. You don't need to go above that. If you're in an advantageous tax bracket, your short-term losses are going to offset long-term gains, which maybe you don't want to do that here.
Exactly. The point, by the way, did you say something about a moron? You just called me a moron? Anyway, we'll talk more on that.
Yes.
Anyway, so to his point, what he was explaining is if you're in the lower income tax brackets, which, by the way, is a reason why you take gains. But let's say I had $10,000 in gains and my tax rate is 0%. Why would I take losses against that? I'm not taking advantage on the federal side. I'll hold losses until the following year.
Well, and that is certainly a strategy that we employ. I mean, oftentimes when you're looking at that 10 and 12% tax bracket, which coincides with the 0%, the 10 and 12% ordinary income tax brackets, which coincides with the 0% long-term capital gains brackets, a lot of times we'll try to drive people up to the top of that bracket. And we have two ways of doing that. Ordinary income, we can take more ordinary income and pay 10, 12% tax on it, or we can take long-term capital gains and pay 0. And sometimes you look at that and you say, okay, well, if we're going the gains route this year, let's drive our gains up to the top of the 0% threshold, and then wait till next year to take the losses. And then next year, we're using the losses to offset ordinary income.
Correct.
As just an example of that strategy is why you want it. That's a scenario where you could be capital gain harvesting, where you could be taking capital gains and paying our favorite tax rate on that, and then hold the losses for the next year, and maybe don't take the capital gains next year and offset the ordinary income.
Great. That's exactly what I was going to talk about in the next segment. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained. As Nick stole my thunder at the end of the last one, I was basically going to start off the second segment. Why in the world, everybody you hear all the time talking about tax loss harvesting. This is an example that I wanted to talk to you about tax gain harvesting. Mm-hmm. Okay. And to Nick's point, I've done this a bunch of times. We will intentionally take gains. Now, who in their right mind would intentionally take gains? To your point, if there's somebody who is in a lower income tax bracket, and it happens a lot that their taxable income, they can go all the way up to the top of the 12% tax bracket, which is like $95,000 or $96,000 for married, and their taxable income might be 30. We could take $65,000 in long-term capital gains and pay nothing. So the question is, well, why do it if you're going to pay nothing? Because I'll tell you what, when you do that, you're effectively resetting your cost basis. So if I had investments that had a cost basis of $35,000 and were worth $100,000, I sell them all. I post $65,000 in capital gains on my tax return, using that example where I pay no tax. I now have a $100,000 cost basis. So if for some reason the value of that investment goes from 100 to 90, now I could post $10,000 in losses that'll offset my income in the future.
Yeah, exactly. And I think one thing we maybe should cover too is what a wash sale is, because that does play a role in this whole scenario. So backing up a little bit, with a wash sale, the government doesn't want you to just be taking losses and buying your investment back. If you sell your S&P 500 fund, for example, at a loss, you can't just go back in and buy it back right away. You have to wait at least 30 days or else it's considered a wash sale. And what it's doing is it's washing away your losses. If you were to sell it at a $10,000 loss and buy it back right away, you can't use those losses anymore.
Correct. So you reset the new cost basis for the higher. It pushes it out. And by the way, it's a nightmare for tracking.
Yes. So just be mindful of that. You can't just take your losses and then buy your investment back. You have to be buying back a substantially different investment is kind of what they...
It's not substantially different. It can't be substantially the same. And it can be gray. So in other words, if I'm going to buy the S&P 500 fund from one company and sell it, and then buy the S&P 500 fund from another company, that doesn't work.
Yeah.
Okay. But if I wanted to buy a large cap value investment, shall I say, sell it and buy another one that is not substantially the same, then that's allowed and it does not fail the wash sale.
And there's no such thing as the wash sale at the gain. There's no issue there. You can take your gains and buy it back right away. To Mike's point, you can use that as a way to reset your cost basis and buy the same investment right back if you'd like. And the government doesn't care if you're doing that because they're theoretically getting their tax dollars that year anyways. They don't care if you do that. So you don't have to worry about a wash sale with the gain, only with the losses.
I can give you another example of a reason why you would take capital gains. I'll give you the example. It didn't work for us, but it could have. I remember in 2017, in January of that particular year, we bought a technology fund. That bad boy was up 50% for the year in December. But we learned that the mutual fund was distributing a 40% short-term capital gain. I'm like, man, I'll tell you what. If I had $100,000 in that thing and it was distributing a $40,000 short-term capital gain, that's horrible. I would have sold it, except that we were at a 50% capital gain, short-term gain. Had I bought that investment more than a year beforehand and I was up 50%, I would have sold to take a 50% long-term capital gain to avoid the 40% short-term capital gain, because in almost every instance, 50% of a long-term gain is going to be less tax than 40% on the short-term gain.
Yep. Yeah.
So I've also taken gains in other situations that are a little rarer, but in the case where we had children who owned a trust, or they sort of owned a trust. It was an irrevocable trust established by their parents. And we had gains in the trust. And the gains, the way they were set up, were grantor trusts, where any gains were effectively charged back to the parents. Let him pay, right? Okay. Anyway, but there's a reason why we did it. Because the parents were already in the estate, above the estate tax limit. So by us taking the gains inside the trust, what it did is the parents had to pay the tax on it, but it reduced their estate that otherwise 40% was going to the Fed, 4.5% going to Pennsylvania. Basically, what we did is we saved 50% of that tax to the parents, 44.5%, by taking a gain that eventually would have had to have taken anyway.
Mm-hmm.
So at the end of the day, it ended up being, half the cost of the gain.
Yeah.
All right. So that's another example of doing it. We had a case study this morning. You saw that written there.
Yes.
We had a case study this morning. We're talking about real estate. Okay. That's a very interesting difference. If it's your primary residence, let me back up. If it's a rental property, it operates the same way. If I bought a $300,000 property and sell it for $350,000, I got to pay gains on the 50. But if it's your primary residence, it's interesting. You get $250,000 capital gain exclusion if you lived in that property for at least 2 of the last 5 years. So we were having this discussion this morning about a particular client we have who is getting married, moved out of his primary residence and cohabitating. Okay, they got married. And he decided, I'll just go ahead and rent that other property out. I was like, okay. I said, but wait a minute. He's been out of that property for 2.5 years renting it out. I said, but, and the renter was getting ready to move. I was like, well, wait a minute. Since you lived in that property 2 of the last 5 years, if he sold that property now, he would get a $250,000 capital gain exclusion. Now, he lives in California, and we calculated this morning that $250,000 capital gain exclusion is saving him $70,000 in taxes. All right? That's an example where it works.
Yeah, I don't think people often think about the capital gains with real estate just because a lot of times if you're dealing with just primary residences and you haven't maybe lived there for too long, that capital gain exclusion eats up a lot of the gain. But I mean, technically that applies to any asset you buy. You can have a capital gain, whether you buy it for one price and you sell it for higher, that's technically a capital gain, whether that's a stock, real estate, or any other asset.
Yep.
Yep.
So there's another thing to also take into consideration, which is problematic. And we're running into it again this year. In fact, I used that example from 2017. But we're running into this year where most mutual funds are distributing capital gains up to 10%. And, we're doing a lot of tax planning with folks that we don't want their adjusted gross income to get up above a certain dollar amount. Now, this isn't exactly tax loss harvesting, but it could be. Because what we're doing is we're taking a look at someone who might be up against IRMA, which is income-related monthly adjustment amount, which is if you exceed a certain amount, you have to pay extra for your Medicare premiums. Or if you exceed a certain dollar amount, you might lose your child tax credit if your AGI is above a certain level. So we look at these things and all of a sudden we say, oh my goodness, we got all this money in mutual funds and now they're distributing capital gains.
Yeah. And you don't have any say over that. I mean, they're distributing. If you hold that investment, they're distributing that capital gain. Whereas with the other capital gains, you are at least making the decision whether or not you buy or sell it. And you will find those capital gain distributions oftentimes in mutual funds. They technically can happen in ETFs. It's just substantially less common. So one thing we do when we're dealing with non-qualified regular investment accounts is we tend to lean towards the ETFs for that exact reason.
Right.
Because I like being able to control those distributions and control those gains. And with the mutual funds, you don't have as much of a say there. When you're trying to do tax planning, it makes it a little bit more difficult because it's income. You don't necessarily know exactly what it's going to be until it happens or till the fund company releases it. That's why we typically will go with the ETFs. And it doesn't help that they don't give you these figures until December.
Right.
Until they're giving you the final numbers, and then the distributions are typically happening the second or third week in December. So doesn't give you too much wiggle room there when you're doing the year-end tax plan.
No, it doesn't. It doesn't. And we're dealing with that right now with a whole bunch of different clients, one of which we're trying to do Roth conversions because it makes sense, but we're trying to keep their adjusted gross income below a certain threshold so that they can continue to maximize on the child tax credit. You got others where you have the potential of their adjusted gross income going above a certain threshold and their Medicare premiums go up. That may be an instance where you wait to see how much capital gains are being distributed by the mutual funds, or if you bought it mid-year, this is an example, you bought it mid-year, you might be up 1%, but that stinking fund is going to distribute a 10% capital gain. It may be worth taking a 1% short-term capital gain so that you don't have to pay the tax on 10% or have it impact other areas of your adjusted gross income.
Mm-hmm. Yep.
So there's a lot of reasons. It's just one of those things that he who knows the rules of the game generally has an edge at the game. And, really, it's a function of maximizing tax efficiency and just understanding the impact of taxes on capital gains and how you can allow the tax laws to work for you as opposed to you working for the tax laws. Everything here that we're talking about is black and white. There's no cheating involved. It's just let the rules work. You work for the rule. Just do it right. Make it to your advantage.
Yep, absolutely. I mean, that goes with anything. Tax planning, retirement, all that fun stuff. Let the rules work for you as opposed to you working for the rules.
Correct. So anyway, if you have any questions, I hope this was helpful to you. If you have any questions, we welcome you to give us a call. Our phone number is 610-422-3773. Or if you wish to peruse our website address is www.maaplanning.com. That's MAA as in Menninger and Associates, planning.com. We're always happy to help, happy to teach. And if there's anything that we can assist you with, please do not hesitate to reach out. I hope you have a wonderful day. Thank you very much for joining me.
Yeah, thanks for having me.
Have a great day and have a great week. See you next time.